Hello and welcome to the Informed Investor. Today we are diving into the Federal Reserve's recent decision to cut interest rates by 25 basis points. Now this move just after Donald Trump's return to the White House marks a significant step aimed at stimulating the US economy. Now stay tuned as we explore the ripple effects that this decision could have on the markets, borrowing costs and the global dynamics. Starting with the market reactions, the US stock markets, including major indices like the S&P 500 and the Nasdaq, reacted positively to the Fed's move, hitting record highs. Meanwhile, in India, the Nifty and the Sensex took a more reserved stance, showcasing mixed results and dipping slightly by 0.3% in light of the Q2 earnings. Now, the recent cut brings the benchmark rate to 4.75% following a 50 basis point reduction in the month of September. Now, this cut of 0.25%, which is the second of 2024, comes as the inflation, which peaked at 9.1% in the month of June 2022, is now on track to reach the Fed's target of 2%. Now, the Federal Reserve's move, anticipated after signals in its September meeting, aims to make borrowing cheaper, stimulating both the corporate expansion as well as the consumption spending. When interest rates fall, the borrowing costs for the businesses as well as the consumers drop, encouraging investments, job creation and spending as well. Now the effects extend beyond the US borders too. For India, the lower US rates widen the rate gap, making it more attractive destination for the investors pursuing a currency carry trade strategy. Now this could boost the Indian sectors like IT and consumer goods as American corporations expand budgets, potentially increasing demand for Indian exports and services as well. Now the US Treasury yields, especially the 10-year yield, fell in response to the rate cut, signaling market expectations that the Fed may maintain lower rates if economic conditions remain soft. Now this trend often implies a longer support period for the economic growth to actually play out. Now Trump's agenda introduces an interesting twist. His push for the tax cuts and higher tariffs could provide a boost to the US economy in the short term. But these policies may carry the risk of accelerated inflation. Now, if the inflation spikes, then the Fed may be forced to pause or even reverse its rate cutting strategy earlier than expected. Now, as a result, the bond markets are cautiously pricing in the potential for higher inflation and yields in the future. Now, to conclude, the Fed's actions aligned closely with the expectations, with the gradual easing likely to continue depending on the future economic data and various indicators. Now, bond markets are reflecting higher inflation expectations, with some concerns that the Fed's easing could be premature. Now, with Trump taking control of the United States and her policies, there is a risk that inflation could re-accelerate. Many analysts anticipate that Trump's policies such as the tariff hikes and tax rate cuts will likely boost inflation, which could push yields higher and slow the pace of future Fed rate cuts. Moving ahead, there are certain factors to watch. First is the labor market conditions and how the unemployment rate stabilizes, followed by how the economic policies under the Trump administration unfold. Having said that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.